in a first on CNBC interview for a closer look at the quarter. Affirm's co-founder and CEO, Max Levchin, or maybe just founder. I don't know if there's anybody else involved in that. Max, good to see you. I want to focus on the guide to start because that's getting a lot of attention. What about the state of the consumer and perhaps the retailer is leading you to be as conservative as you are?
Well, first of all, we're actually not being all that conservative. If you compare on a 2-year basis, our forecasted CAGR is 60%, almost 40% CAGR on revenue at the midpoint. So these are what I would consider, I think what most people would consider to be exceptionally strong growth company numbers. We are lapping a year when we launched Amazon and scaled up Shopify to its fullest scale, so far. And so we're obviously comparing to some outstanding numbers. And the conservatism in my guide, if you want to look for that, isn't coming from our ability to continue growing the business, which we think extends decades, but the fact that if we were to open up the credit box more than we think is prudent, we will probably see some pressure on unit economics. And the single most important thing I care about here and my entire executive team cares about is protecting those unit economics, making sure that we continue providing exceptional yield for our capital partners, and most importantly, not overextending the consumer. So it's a conservative view in a sense that we don't know what the credit future looks like. I think the economy is not in the healthiest place. We just heard Jay Powell speak just to that point. And so I think we are being very cautious in managing credit, but we are extremely confident in our ability to grow the business.
And that's what I wanted to get to is the macro and your expectations of it. I also think it's interesting, given Peloton's really bad quarter and the fact that you used to get a really huge percentage of your business from Peloton. It speaks to the diversification over the last year plus. So tell me, what are the fastest growing categories and what is your approach to international expansion going to be, even as we have this somewhat murky macro picture?
Exactly. So we see our growth coming from multiple different domains and new merchant expansion. Our fastest growing category is what would be unremarkably called general merchandise. And that, of course, covers the very, very large scale partners of ours like Walmart and Amazon and Target. And so there's just an enormous amount of expansion within their user base, within their product opportunity. So that's been growing extraordinarily well, squarely in the triple digits, and we see wonderful things there. In addition, we are a product-driven company. We're innovating on products very, very aggressively. Debit Plus, my favorite project of the moment. I'm spending an enormous amount of time of my own on it. We're seeing just unbelievably good engagement metrics. Consumers are using it almost 50 times on average more per year than any other Affirm product. So should give you a sense of just how much more engagement we expect. And then the third leg of our expansion plan is international. We're on the record now saying that the next geography is United Kingdom. We saw just exceptionally good growth in Canada. We serve lots of our US partners there. We partner with some folks in Canada exclusively, and just has done really, really well for us. We expect to do the same thing as we head across the pond.
Max, that diversification, however, has cost you in terms of your take rate or what you earn off of each transaction. When I look back over your financial results on a quarter-over-quarter basis, revenue has been flat. It's also, as a percentage of GMV, has decreased over the last year. So what are you giving up here? And also, when you look at this Amazon-Peloton partnership, is that an opportunity for you, or is it a problem? Your take rate is so much higher with Peloton. Now that it goes to Amazon, does that set the precedent going forward?
So first of all, the take rate metric is a result, it's an average, and it's a result of a mix. And we talked about this before, but mix change for us is a really important driver. The fastest piece of our growth right now is coming from what we call split pay. I think folks call it pay in 4, but it's a typically, and for us is no exception, a smaller percentage of GMV that falls down to revenue and ultimately revenue less transaction cost. Our long-term guide for revenue less transaction cost has stayed between 3 and 4% for a very, very long time now. This quarter we just reported, we kept it at 4.3, which is well north of our long-term guide. So in terms of our actual bottom line metrics, we think we're doing extraordinarily well. As far as Amazon Peloton new announcement goes, a little bit too early to report. Obviously, those are two very large partners of ours. I would expect that we should see incrementally new opportunities from this. It's fantastic that Peloton has found themselves a really great new distribution channel. It so happens that we are already available in it.